Welcome and thank you, Lindsay, and thank you, Margaret from 180. We are here to do the statistics and commentary on M&A. So I'm Graham Frazier. I'm president of Private Capital Research LLC, also a founder of GF Data Resources, which we'll talk more about that in a minute. But I want to go through and self-introduce our panel, starting with Francis Carr.
Great. Thanks, everybody. I'm a managing partner of a lower middle market industrial private equity firm in Houston called Milton Street Capital. We're focused on businesses between about 5 and 20 million of EBITDA. Industrially focused, very operationally focused, sort of messier situations, family transitions, businesses that need some TLC commercially and operationally.
Good afternoon. My name is Charles McCusker, and I'm managing partner and co-founder of Patriot Capital. Can you guys hear me okay? Yeah. Oh, great. Is this better? Oh, okay. Anyway, our office is here in Dallas, in Charlotte, Baltimore, and Chicago, celebrating our $1 billion invested capital last week, actually, or yesterday, excuse me, when our last closed deal. I've invested in 145 companies in the last 22 years, primarily doing private credit. About 80% is mezzanine and 20% is equity. So I'm here to give a perspective from the leverage market. Good to be here.
My name is Paul OUWENEEL. I'm a managing director with Wipfli Corporate Finance Advisors. We are the sell-side investment banking arm of the national accounting firm Wipfli. We work with founder-owned businesses that usually have never had institutional capital before. We help them make a market for their company, and we sell to folks like Charles and Francis here, and as well as Graham. So typical deal size is probably $50 million on average, and range anywhere from 25 to 100 is where we play most of the time. So lower middle market.
Thanks, guys. So yes, we have a great group here. So we're going to have a discussion around what's going on in the lower middle market these days. I'm going to start by talking through a few statistics from GF Data from the latest report. So GF Data is a database of private equity transaction information. These are data and statistics on valuation multiples, debt pricing, excuse me, key deal terms and capital structure dynamics on transactions, again, from 10 to 500 million in enterprise value. GF Data started in 2006. My partner, Andy Greenberg, Bob Wegbright, who you know here probably as well, who's back in the corner there. Be happy to talk with you. And I sold the business to ACG Global. That deal closed in March. So it is now GF Data and ACG company. We still have some affiliations with the company. And anyway, I'm not sure what that noise is, but so the idea is that these are transactions from 10 to 500 million in enterprise value with a TTM EBITDA multiple of 3 to 18 times. We recently expanded from 10 to 250 to include the 250 to 500 segment. Which is still building out, and that data will be starting to be published over the next couple of quarters. I'm going to talk for like 5 or 6 minutes here about some statistics from the recent report, and then we're going to use that as a backdrop to sort of set the stage, because GF Data looks backwards. These are completed transactions. There's not a lot of speculation about what's going to happen in the future, whereas our conversation today is going to be focused on what's happening today and what we think might be happening for, say, the rest of the year, at least the next 6 months. If you look at the valuation overview slide, this is the top level slide for our entire data set. There's over 4,300 deals completed in that data set. Each one of those deals are completed by a private equity sponsor, and there are approximately 25 data points of data entered per deal. So there's a big pile of data in the system. This is the overview slide. All the data cuts go 10 to 25, 25 to 50, 50 to 100, and 100 to 250 in enterprise value. The 250 to 500 segment will be built out and reported on over the next couple of quarters. I can tell you in Q1 2022, which is the latest period for which we have data in the system. The 250 to 500 segment was at a 12.1x multiple. So size does matter when it comes to deals in terms of their valuation multiples. When you look at the year-to-date 2022 numbers and you look at going over the past dynamics of the deal market, you wouldn't even know we had a pandemic because you have to look and drill down into the quarterly data to see that. What we've had is one of the most robust deal markets we've seen in years that has been very persistently strong for a long period of time. The multiples are as high as they've ever been. These are averages. So 7.3 times EBITDA on an average multiple is as high as they've ever been reported to through the system for GF data. If you drop down into the quarterly splits, what you'll see is that during the pandemic, when the market really started to shut down, which was 2Q 2021, the multiples didn't drop. The volume dropped off significantly, but the multiples didn't really drop. And what happened then in Q3 was the volume started to come back, but the multiples came down because the deals that got done in Q2 were the deals that were high enough quality that were going to get done anyway, regardless of a pandemic or a cycle. They had the momentum, they had the quality to be able to get done. In Q3, you started to see sellers capitulate a little bit and say, okay, well, I don't see it getting any better. Let's get the deal done. You're starting to see a little more of the lower quality deals creep into the system there. And so the multiples came down as the volume came back. Q4 2020 was a very high volume quarter, and the multiples came back a little bit. The market, it was actually a pretty quick bounce back from COVID, given some of the shock absorbers in the market that we're going to talk about today as well, particularly the debt markets having developed so much around the private debt availability. If you go through 2021 quarter by quarter, the market came back strong. COVID was still happening. The pandemic was real. And the volume might have been a little bit muted, but frankly, the dynamics were there still for a very, very strong M&A market. When we get into the Q4 2021 period, and we had a record valuation multiple-wise in the 100 to 250 value, valuation range, 9.3x as a average valuation multiple, very, very high. And across the board, multiples were up. And then Q1 hit, and we start to see some changes. And we're going to talk about these changes today, which are implementing and embedding themselves into the market as we see it today, including the invasion of the Ukraine, interest rate changes, inflation creeping into the system, supply chain issues exacerbating and continuing much longer than anyone had thought. So I think I get more fodder to talk about today. One of the main issues, or one of the main factors in the current market still, if you go to the shaded right-hand column here, in the most recent quarter that GF Data has information for, is the quality premium. And, we get into a situation here that's not too dissimilar in Q1 from the beginnings of the COVID pandemic, and that is that higher quality deals still get done even when the market is challenged. And what you see here is a high incidence of that happening. 67%, just slightly more than 2/3 of the deals that got done were of the above average quality. GF Data defines that above average quality as 10% EBITDA margins and 10% TTM revenue growth in the period up prior to close. There's a couple of nuances around that, and there's a little bit of judgment in that, but basically those are the metrics that define what we call a higher quality deal versus the other deals in the system, noting, of course, that the other deals in the system have met the institutional equity standard to have a deal complete. So these are, in fact, all nice quality deals. We're trying to differentiate even the A pluses from the B pluses, so to speak. Again, a lot of this is about the deals that, in fact, didn't get done and what's happening with those deals that maybe just aren't quite up to snuff from a quality perspective. From a leverage perspective, we're going to talk about that a bunch today. The actual debt utilization declined in Q1 2022, 3.2 times for total debt. This is for platforms only, but for all deals in the system, 3.2 times senior debt, 3.9 times total debt, versus in 2021 as a year, 3.3 times senior debt for the year and 4.0 times total debt. So we saw the little bit of a back off in debt utilization in Q1. From a capital structure perspective, GF Data publishes a lot more data than you see in these slides, but we saw the equity percentage in the capital structure come off a little bit in Q1. Debt backed off a little bit too on average, but that was made up for by a little bit more robust usage of mezzanine debt and subordinated debt in the system, as you can see from the bar chart here. The lower gray part of the bar is equity. The middle darker green is the subordinated debt or mezzanine segment of the capital structure, and the top of the stack is senior debt. I think that's where we're going to stop now. We can get into a couple of more dynamics later, including some key deal terms. Leverage pricing, by the way, doesn't show so much in this slide, but we've certainly seen pricing come up. And one of the dynamics we want to talk about today also is how debt pricing plays into the markets that we're playing in versus the availability of debt capital. Enough on the sort of the intro set. We really want to get into the conversation now, and I'd like to go through with each of our participants here, realizing that we've come into Q1, we're into Q2 now, well into Q2, and we don't have data from GF Data to publish on Q2 yet. But now that we're starting to see that data come together and we're moving into the second half of 2022, where are we today with the war, the inflationary influences that we're seeing, interest rates coming up to combat that, et cetera? How's the pipeline look? And from your perspective, Francis, from the Milton Street perspective, in the current market conditions today, with all the changes that have occurred with that backdrop?
Yeah. In terms of number of opportunities, do you have the slide of our deal flow in here?
Yep.
In terms of number of opportunities, second quarter was a record for us. We average about 100, 110 deals a quarter for the last couple of years. And in the second quarter, I think we saw 175 new opportunities. So things have accelerated, and I would say even here in early July, it feels like we get 10 new opportunities a week. It's almost picking up, but it also has a little bit of the flavor of rats jumping off a ship, because what we're seeing now are businesses that are less attractive. They're in cuspy industries. They're in areas that are clearly going to be impacted by interest rates, like building products, for example, construction-related businesses, big project companies. And then embedded in all of those deals, you have this massive issue around materials inflation and labor inflation, and then artificial demand that's still happening as a result of COVID and supply chain problems, that these companies are sort of on the tail end of experiencing that. And you sort of get the sense that at any given quarter, the earnings are going to come off, and we as buyers are going to be left holding the bag. So deal flow is up. I'd say we're much more skeptical today than we were 60 days ago because of that, and we're being more selective.
Thanks, Francis. Charles, would love to hear from your perspective how things have been developing for you over the past quarter or two, and how you see the status of things today.
Yeah, sure. So we're a little bit, we lag behind Francis and Milton Street, and even lag further behind Paul and you guys. So our second quarter was really slow. And I think that was really driven by, there wasn't a lot of deal activity being either shopped in the first quarter from investment bankers, or there's just, everybody was so busy in the fourth quarter of 2021 and needed a break. So we closed a couple deals in the first quarter, financed a couple deals in the first quarter, and the second quarter, none, actually. Now, having said that, the third quarter, we're looked to close probably 4 or 5 investments. mostly funding M&A transactions. I will say this is a very unusual time for me, and having done this for 25 years. Number one, the diligence process is taking as long as I've ever seen it. I think maybe 150 to 180 days from the time that Milton Street gets a signed letter of intent to the time it closes. So all these 90-day exclusivities I kind of look at when I get it to the financing side. It's like, oh yeah, right, sure, good luck with that. Although it's never really our fault. It's something. It's just something out there is taking. We'll get into that a little bit more, I think, a little bit later. But but if you look at our portfolio, thinking about what you said about, there's a lot. Maybe there's some artificial earnings. We have 31 companies in our portfolio. Every one of those, up through what we've seen through the second quarter, every one of those have beaten their numbers from 2021. They might not all beat their budget, but they're ahead of where they were in 2021. So we hear about these things about the recession, and I read the Wall Street Journal. So, I'm not seeing that in our portfolio yet. So it's just a very interesting time, especially if you're a new investor or an investor coming in. It's like, what's real, what's sustainable, and then how can we finance it, which we'll get to a little bit later.
Sure. So 150 to 180 days from LOI to close. That's
153 has been our last 7 deals. And it will never be Patriot Capital who is the last one to slow that down, because we're not a regulated entity, right? I will tell you what has taken a long time, and the deals we're closing right now is reps and warranty insurance, and the underwriting of that. The underwriting has taken a lot longer than it's ever taken, and that I can remember, with that product being out there.
Okay,
maybe we're talking to the wrong people.
In support
Still call
of
me.
Milton Street having closed a deal together in the past 6 months or so, I think it was in December. I believe that deal closed on time from the date it was signed in the LOI, which was very impressive.
Kind
if
of
you work
shocking,
back
yeah.
from that date from the start, it helps. But boy, a lot of diligence went into that.
Yeah, we cut our fair share of corners to make that happen. So
Well, and Charles, you've also got a great perspective, because of under your organization, you've got an advisory, sell-side advisory, Patriot Capital, which is the sort of the bigger entity, and then also a buyout group. So you get sort of the leading, the current, and the lagging indicator.
Right. I will say that. I'll let Paul talk about his M&A side, but that's starting to pick up after about 6 months of being pretty quiet.
Okay. Well, Paul, so give us a report from WCF and your perspective as a sales side advisor.
Yeah, talking to my peers, I think a lot of you in the room probably have felt this. Last year was nuts. Everyone was busy 24/7 the whole year. Q1 came, and Charles, I think your comment is what we saw. There was, I'll call it a breath. There was still activity, and then Q2 came along, and the activity has, from my perspective, just picked up steam every month in the quarter. The last 3 weeks, I've been in more meetings with people who are interested in selling, and I might have been the entire first quarter. Is it rats off a ship? I don't know, maybe not. Is it trying to catch the train before it leaves? It's funny, all the dynamics everyone here so far has brought up is a lot of it, or there's companies who just had unbelievable 2021s. Their accounting firm has finished their audit, their review, whatever you have it, and they're looking at these numbers going, oh, maybe I can get a 10 off of this really, really large number. And so my perspective is, I think the rest of the year, I think it's going to be busy. I think it's going to be very busy. But I think us as bankers are going to earn our money big time this year, because I think, and that's going to start from conversation one with the prospect when they show you their 21 numbers and maybe even Q1 or Q2 LTM this year. And you start having the conversations, okay, let's talk about Q3 and Q4. Let's dig into these numbers. What are your end markets? Talk to me about your customers. What's your product? What's driving this revenue? And a lot of it, quite frankly, that I've been having is level setting expectations with these prospects, helping them understand and helping them look deeper than just the headline and say, okay, here are the dynamics. Here's where multiples are in your industry. Here's how a buyer is going to analyze this opportunity. And so this is how we're going to position in the marketplace. But, maybe you thought, your friend, at the tennis club or wherever said they got sold for 9 or 10. Maybe you're a cyclical. We've talked to a lot of cyclical companies that are coming off some pretty good years. You're probably not a 9 or a 10 now. Are you still a seller at a, still not a terrible multiple, but lower? Is it 6? Is it something around there? And where you have valuation expectation alignment, I think there's still going to be quite a few deals that get done. But I'm not interested in broken deals. I know most of you aren't either. So I have no interest in taking someone to market where they think that they're going to sell at a 9. And I said, no, you're only getting 6 or 6.5 or 7. And then we don't have a busted deal. So there's a ton of diligence on my end, educating and digging in and understanding the story so that I can give them my best advice and we're all aligned going into market.
So as they say that rats that can swim jump off the ship first, right? So from a quality mix perspective, you're saying that you're seeing more people and more people say, you know what, before I miss this window, let's bring my deal to market.
The quality, right? I don't want to say a company is not as bad or is not high quality, but you have some companies that, we're here, and all of a sudden jumped up here. That's not to say it's not a high quality company, but is that the sustainable earnings that a buyer is going to expect to get and pay you off of in the future? To me, that's a bit more. The high quality is how sustainable is your business model? How sustainable are your earnings? And then to me, that's when I hear high quality, it's almost sustainable is what is synonymous to me.
Right. So we're getting into a situation where maybe the pandemic type of performance is moving more towards the rearview mirror. But I think what you're saying is, and I think what we should move into is the challenges in valuing a business in this current environment. When you have that moving into the rearview mirror, but then you've got current environment that has a lot of uncertainty to it. Francis?
Yeah, we're looking at a business right now that's a backlog-based equipment manufacturer. So they've had record earnings for the last 2 years. They're looking at a 2022 that's going to be up again 25%. And rightfully, the sellers are thrilled. The management team's thrilled. They're doing a great job. But as we look at the business as a buyer, we have to be thinking about 2023, 2024, and have to unwind all the elements that drove their record numbers, because ultimately this is not a true growth industry. They may have had some wins at the customer level. Maybe they have a new channel available to this company. But if you peel the onion back a couple layers, you see unit margins, unit level profitability doubling in the space of 24 months. You see demand for the product doubling. And in a world where half of the manufacturing world was almost unavailable, right? Supply chain problems cut a lot of people out of the market. So if you could make something and get it to customers on time, you got to name your price and you got all the business. So looking forward and trying to figure out what 2024 looks like, right? It's the ultimate crystal ball. But I certainly know that 2021, 2022 are not sustainable numbers. And that's to your point, not a knock against the company. It's just the reality of we're gonna own this thing, and we're gonna have to live through what the unwinding of. I still think it's COVID hangover. What that unwinding looks like, and I just add on the valuation points. We've always looked at the world that way. Having those conversations with sell side bankers was virtually impossible until about 30 days ago. All of a sudden, people are a little bit more open minded to say, "Okay, I hear you. You're not completely unreasonable. Let's sit down with management and see if we can collectively unwind this." So we're starting to see some rationality there, and whether that results in actual transactions for us, I don't know, but it sort of feels like we're right at the cusp of coming back to something that's reasonable.
Interesting. Charles, how about you? In terms of how businesses are being valued in the very current environment, what kind of changes have been developing?
Well, so I think it's very similar to what Francis has said with one other thing, because I still have to look at a business from a debt lens, right? And we have been we have been more cautious this year in terms of, where we're comfortable with leverage levels, even more comfortable where we are with, how much capital needs to be invested in this business to sustain these earnings. So that's the part that is hard to kind of get our heads around. And then, what's the appropriate capital structure, for the deal. So that's what's taken a little bit longer on the underwriting side. And what is an underwritable EBITDA that we're going to get comfortable with? What I've seen, talk a little bit about the leverage levels now, or leverage. This is the second quarter, is the first quarter where I started to see regulated financial institutions start to pull back a little bit in terms of their leverage levels. Not, middle market banks, right? Not seeing it in the big credit funds yet. They're really driven by how quickly they can sell off the paper to the CLO market. So that's starting to dry up a little bit. So you may see something there. So I'm really interested to see what the banks, mostly regional banks, are what they're coming out with their earnings are. What I think you're going to see is very strong earnings because they don't have to take big loan reserves yet. So their earnings are probably going to be pretty strong for the second quarter, and they're going to say, yeah, but we're going to give you a lower outlook because we may have to take more loan reserves going forward. And that's just the way to say, hey, we're going to be a little tighter.
Because they unwound so many of these loan reserves over the past year.
Oh yeah, a lot of them. I mean, they had big ones in the first quarter of 2020, right? I mean, they took huge, just like we did. We took major loan reserves in the first quarter of 2020, and been able to kind of capture those back, in the last 18 months.
Right. We'll keep talking about debt in another minute. But Paul, from your perspective, the challenges of valuing and advising your clients regarding value in the current environment.
Yeah. I don't have a ton to add, I think, to what Francis and Charles have already added, but two things. Number one is, as an acquisition advisor, it's my job to understand your story and then position it as best possible. So it's peeling back those layers, understanding it, and then figuring out what the best or most advantageous way to position that is. There is a reality here, Francis, for all the analysis and the onion peeling and the finance math and K's and G's and LBOs. There's a supply and demand issue going on here, and the supply is in the capital providers and the buyers, and the other side of that is the sellers. There are still today tons and tons of buyers. There is so much capital chasing deals. When that, I think, has as much to do with adding a turn, a 2 or 3 to a deal. I mean, really? Well, someone needed to put capital to work and was willing to, see a G that no one else saw in that multiple. So to me, I still think that dynamic remains intact. And I don't know when that C is going to recede. So as an investment banker, I mean, right now, that dynamic, supply and demand of buyers to sellers, is still in my client's favor.
Oh, and I think you have that for another 2 years, at least.
At least. All right, what
there seems to be no end in sight for the amount of dry powder. I mean, the debt markets are awash in it, and the equity markets are too. One of the dynamics in the debt markets that I definitely want to hear a little more from you guys about is the fact that during the great financial crisis, we were really relying on regulated banks going into that for leverage for deals. And there was a fair amount of dry powder at the time, too, from an equity perspective. But from a debt perspective, you really were relying on regulated banks that had reserves to cover and other compliance issues. Since then, over the past 10 plus years, the alternative financing debt markets have developed in a big do both private and public lending sources, and they're flush with capital now. So, you're saying we're not seeing any cracks in that, or Charles, are you seeing, any beginnings of a cycle there?
So I think what you'll see there, that will ultimately be impacted by interest rate rises because, many of those, let's talk about the private credit funds for a minute. Still a big part of their capital comes from regulated banks, right? I mean, all their lines of credits, at least half their capital comes from regulated entities, right? So, and their costs are going up, right? So I think you will see plenty of capital still from private credit funds. You will see that rate go up as, the spreads will be dictated by the market, but, with interest rates going up, the ultimate cost to, buyers is going to go up, which is going to drive valuation down likely. If that's what economics would tell you, but,
Right. Cost of capital goes up, valuations should come down. Francis, what are you seeing in terms of let's comparing interest rate increases versus just pure availability of capital at any price in terms of what is more likely to slow down the M&A market?
Yeah, for us, and we may not be the best barometer of this because we're at the $5 to $20 million of EBITDA range, and we're not heavy borrowers, and that's in the eye of the beholder, right? That's the eye of the borrower. But I'd say our typical cap structure is 40% debt, senior debt only. So we haven't seen any ripples yet or any pushback yet in what we're looking at. For us, whether it's that quarter turn of availability or whether it's 200 basis points of capital costs, that dwarfs, the impact of that is dwarfed by the impact of cyclical issues and the COVID hangover that I talked about before. And that's sort of where I see in our corner of the market, things slowing down when there's just a breakdown in fundamental valuations because the business goes from 15 million of EBITDA to 7, and there's just no way to wrap this, for the seller to wrap their head around the fact that for the next 4 years, it's going to be a $7 and $9 million EBITDA business.
Yeah, I think what we all need to remember is also there's been a significant amount of stimulus money coming into the economy, especially the lower middle market with PPP financing and employee tax retention credits. I view that as just free equity. If you held the assets, you have immediately been, it was immediately accretive. So what, Paul's clients did with that free equity is really going to drive what their earnings are. So the good companies, a good management team have probably, so that's what we have to figure out, right? So the companies that had that stair-step growth, because they got free equity, right? Not free equity, but it's cheaper than Francis. Prepaid equity is a great way to do it. From all you guys, from taxpayers, right? So all of us, excuse me, I'm a taxpayer too. So the really good management teams and really good companies have used that capital and that's where our job is to figure out, hey, is this sustainable or not? Because some people, we have companies that took the money and they did amazing things with it, right? And they were able to build and grow their business, add employees, others not so much, right? But the ones that did that, and Paul can find those, they're gonna still command huge multiples.
Right. Well, so let's shift gears a little bit and go back to one thing that, Charles, you had mentioned before about the availability of resources. You were mentioning rep and warranty insurance providers and things that are slowing down the process. I know, we got into a situation in Q4 last year where, and even Q3, where the resource strains of everything from QOV providers to rep and warranty insurance providers, et cetera. And I know in terms of rep and warranty insurance from a GF data perspective that, the insurers left the lower middle market and basically weren't underwriting a whole lot in the lower tier deals after they had moved into that segment. That came back in Q1. We haven't seen the data on Q2 yet, but in the beginning of 2022, the indemnification caps came back down again. But in terms of the availability of resources on all fronts, legal, accounting, et cetera, do you see that loosening up as maybe the current dynamics take place?
Well, I was just asking Francis if his legal bills have gone up by 100% like ours have. And the lawyers all blame it on not having, they have to pay their associates come out of law school. Like, oh my goodness, I got to find other lawyers. I mean, that has been what slowed things down. It's been finding transaction advisory services to do Q of E, to, lawyers were overworked, to other diligence, and again, the reps and warranty side, environmental, whatever it may be. It just seems like they're saying, well, we can get to you. I mean, we have several go-to firms that you do for Q of E work, and they said, Charles, we just can't get to you, so you have to go find somebody else, and it's just I guess it's just the way it is. And they've had people leave, and everybody felt like everybody was affected by the Great Resignation. We were, many of our portfolio companies were, service providers were. So it's just a little. People are still, at least my mental state is I'm still in a little bit of COVID hangover, so I'm okay with it, and I haven't really pushed it yet. But eventually, some people are going to say, look, if you can't do the work for us, we're going to have to find somebody else, right?
Right.
So I don't know how your clients feel about it.
Paul, are you getting that across the board,
late
or
last
certain
year?
areas?
I mean, if you didn't have it lined up by the November 1st, maybe even, I mean, you weren't, it was 3 months out. It was just absolutely terrible. Everyone was overworked, the QB, the lawyer, everyone.
Not the bankers.
No, we're never overworked. So far this year, between my accounting firm, peers, and other accounting firms, Charles, I'm not sure how this would relate to your experience. They're busy, no doubt. I mean, historical levels of busy, but not that they can't take on another deal. So to me, it has loosened up a bit. I mean, the cost is 50% higher because we're paying all of our associates 50% more than they made 1/1/2020 between that raise in 20, the raise in 21, and now another one here. The costs have just gone through the roof. But in my mind, that's getting them lined up is important, but I haven't had an issue getting sell-side QVs, qualified legal counsel, and our deals have been, knock on wood, haven't been held up. So,
Well, I'm sure there's a few providers in this room and sponsors at this conference that would be would welcome the inquiries for the business that needs to get done. Francis, have you had trouble? I mean, your firm has continued to grow. How are you finding the markets for availability of labor? For people to come in
For internal staff,
Yeah.
It's been challenging. So we've added, I think, 5 people in the last 12 months, which is a lot if you think about a 13-person firm. So we've doubled in size. It's been hard. And what's also funny is the junior staff, and this is sort of an old man comment about millennials. But I had a junior person join, and he came 7 months later, and he said, "Oh, by the way, I think I'm due for a raise because, inflation is serious, and it's cost me more to fill my gas tank." And he had like 10 reasons, 10 lists on a bullet point list of reasons. This guy KKR.
He googled that. He googled that list.
So I said, thanks for the bullet points, but please go back to your cube, and we'll talk at the end of your first year. So I mean, I have the luxury of being in a small firm where I can take that approach. And I pitied the larger firms and having to deal with this en masse.
In investment banking, it's an all-out war. If you have someone that you've decided you can't lose, you almost have to proactively make sure they're getting paid market and today's market, and then show them a path to the top. Here's how, if they're 5, 6, 7 years, here's how you make partner in our firm. I mean, the turnover is just everywhere. People are scalping. People are giving 100% raises. Talk about your costs. I mean, turnover has been just absolutely insane in the banking side.
Yeah, my son worked for an alternative lender up until a few months ago, and they were losing people left and right, and they were below market in terms of their pay scale. And it's a wonderful place to work, and a great quality of life that isn't 200-hour work weeks, et cetera. And they came through in Q1 and did across the board 25% raises to keep people, because they were losing people left and right, and they were like, we can't get anybody else. And they finally listened, the senior level management finally listened to the people that were walking out on exit interviews and stuff. And they're just saying, you got to get up to market here. So, I don't know if that's going away right away.
It's cyclical. It'll come back.
Yeah. Well, we had a bunch of other topics, but we're running out of time. I think, if there are questions, we can keep going, but if there's some Q&A from the audience, we'd love to open it up. We got maybe like 5 more minutes. Is there anybody that would like to bring up any certain topics? Please do raise your hand and we can pass a microphone around. Happy to answer questions. Don't jump at once here, okay? All right.
While you're waiting for a hand, how about the earnout? The earnout seems to be back too. That was a dirty, dirty word in my world.
This is a dirty word.
Earnout? No, not interested. My client is not interested in an earnout. It's there, and it's a way to bridge potentially realistic multiples with maybe a little bit higher multiples. Say, okay, yeah, if you were that company, I'd pay you 9. Let's pay you something that's significantly lower, but we can earn you out on the rest. I will tell you, there's far more openness in a lot of my clients.
What's the longest earnout you would even contemplate for a client?
3. But that's
18 months.
Right. No, it's
3
as
years
high
is
up
a
in the
long
P&L
time.
as I can get it, and as short as I can get it. Right. So.
Right.
We've been addressing that a little bit differently because, again, just institutionally, we're focused on the next 12 to 24 months and thinking, all right, that if the bloom comes off the rose from an earnings perspective, then it has a different impact on our equity return. So we've come at it from back end loading compensation. So we'll give a seller home run options, right? So we'll pay you, the 7 times a normalized number now. But if it turns out you were right, and this new channel you've developed and this new pricing you have that just appeared like magic in the last 18 months is sustainable, and we make a pot of money, we'll share a lot of that with you on the back end.
Yeah.
All right. Well, so we'll just do a lightning round here then at the end and talk about 6 months from now. Say we're through 2022 and we're looking backwards a little bit. Paul, what do you think is going to be the most notable aspect of the second half of 2022 from an M&A perspective?
Assuming the Fed doesn't break the whole thing, I think you're going to see just an absolute whirlwind of everyone who's thought about selling trying to get in. And I think you're going to see just tons and tons of deals come to market and a lot of them not close.
Interesting. Francis?
Yeah, I would echo that. I think we're going to see a lot of transactions, and I think those multiples are going to creep down. Fundamentally, normalized multiples.
Hallelujah for
lower.
the buyers. It's been tough. Charles, what do you think?
Well, I don't think I could disagree with what these guys are saying. The economic side and the inflation side and the supply side, just the part that I can't quite get my hands around or my head around, and that's probably. But the demand is still there. I will say one thing. One of the things you had on your list about, I do think consumer products companies are going to continue to suffer going into the rest of this year. Consumers are definitely pulling back. You can see that in retail earnings. It's that part of the world is softening.
Okay, then that drives the economy.
It does. So I don't know when, but I just our consumer, we've actually gotten out of consumer completely in our portfolio. Sometimes because we wanted to, sometimes because we had to, but we're out of it.
Right. Well, anything that's got a cyclical angle to it, I think you're starting to see. We were talking earlier about a building products distribution company that we had a co-investment in that is being exited. That our client, the sponsor, is really of the belief that this is imminently closing, and they're kind of like, if we don't close this now, we're probably going to wait 3 to 5 years before we're going to have an environment where it's something that's got a cyclical angle to it like that. But I think consumers the same way. And so, having been through a few cycles, when you see the things that are happening now in the market with cost of capital going up and what the Fed's doing to combat it, tightening, et cetera, valuations should come down. Whether or not activity comes down or not, I don't know, because there's such a shock absorber in the system with all the capital that's yet to be deployed.
So I'm going to plug the winter conference because you'll get to see GRAEME again. Maybe not the three of us, but you'll get to see GRAEME again. He'll have the results of our prognostication at the winter conference in St. Petersburg.
We can only hope. We can only hope. Thanks very much, everybody, for taking the time, and thank you guys.